Hello traders, this is Fawad Razakzada, market analyst for City Index. Today is the 2nd of July 2024. The dollar remains largely supported thanks to political uncertainty in Europe, while the Japanese yen continues to weaken against the US dollar, with the Chinese yuan also weakening in recent days. The dollar index yesterday found support at 105.50, this level right here, which was previously support and resistance, where we also have the 21-day exponential moving average. So support came in right where it should have really, and the dollar index bounced from there, rising towards 106. From here, it looks like the April high could be the next target at 106.51, and thereafter you don't have anything significant until the October 2023 high at 107.35. Will we get there? Well, it depends on the outcome of this week's economic data from the US. We have a number of key economic indicators coming up, including the ISM Services PMI, the US jobs report, and a few other economic indicators as well. On top of all of that, you have the political situations in the UK and France, which could keep the euro dollar and the pound against the dollar in focus this week. So let's start with those currency pairs first of all. There was a bit of relief rally in the euro dollar, but that momentum quickly faded, and now the currency pair is back at around 107 area, which has been a key level for the euro dollar in the recent trade. It hasn't really broken decisively below that area, finding support between the 106.50 to 106.80 area, where we also have a bullish trend line going back all the way to October coming into play. So that area remains key. For as long as we don't break that area, I think there's a potential for a bit of a recovery in the euro dollar. However, if that area breaks down, then the April low at 106 will come into focus next, ahead of potentially 105, but we'll cross that bridge if and when we get there. In terms of resistance, 107.50 is important, as you can see by this area here. Above that 107.90 to 108 is where we have the 200-day moving average converging with prior resistance and support. So those are some of the key support and resistance levels to watch this week, and depending on the potential direction of the breakout from this range, we could see some follow-up technical buying or selling in that direction. The cable has been drifting lower ever since breaking out of this bullish channel, and recently it broke down this area of resistance at around 126.80 to 127 area, and since then this area has turned into resistance, providing a ceiling on this currency pair. Short-term support comes in at 126.35, which has been tested a couple of times, and so far it has held, but judging by the shape of yesterday's candle, we could see some further downside follow-through if we close below 126.35 today. The next key support area comes in at around 125 to 125.50, which is where we also have the 200-day moving average coming into play. And this area was previously support and resistance, as you can see by the shaded area. There's no clear directional bias on this currency pair, like most other currency pairs right now, but that could change hopefully once we have the elections uncertainty out of the way and we see the release of the upcoming US data, which could set the tone for the remainder of this month. Now, one currency pair that has been trending strongly is the dollar yen. In fact, all the Japanese yen crosses have been rallying because of a very weak Japanese yen. And so far, we haven't seen any intervention. We've heard from the Japanese officials that they might be intervening. But because of the slow pace of this rally, rather than a sharp ascent, I think the line in the sand has been pushed higher for the Bank of Japan or the Finance Ministry of Japan to intervene in the FX markets. I think 165 is now touted as the key level to watch for potential intervention should we get there. But at around current levels, we haven't seen any signs of intervention like we did, for example, last month or in April, in fact, when the currency pair dropped sharply. But that could happen at any time, so that's a key risk facing investors. But in any event, we'll highlight some key levels to watch. Now, 160 was previously resistance, and now that we've broken above it, it could turn into support on a potential retest of this level. Below that, we don't have anything significant until this bullish trend line, which comes in at around 157.70-ish, depending on how fast or otherwise price gets there. On the upside, because the dollar yen is trading at multi-year or multi-decade highs, we don't have any major reference points to target, but we do have these Fibonacci extension levels that I've plotted using the most significant recent high to the most significant recent low. and the 127.2% extension comes in at 162.48, followed by 165.37, the latter being the 161.8% extension level. Gold is not out of the woods yet. I know we've broken out of this bull flag pattern to the upside, but I was expecting to see a more significant follow through. So far, that hasn't been the case. So as things stand, I think we need to see some more price action on the bullish side before turning tactically bullish. But one thing that the consolidation has done here, that has been in place for the last couple of months, is that it has allowed the RSI and other momentum indicators to kind of work off their overbought conditions, and not only on the daily time frame but on the higher time frames as well, like the weekly chart. So gold is no longer overbought, but we do need to see a clear bullish signal to suggest that the bullish trend is about to resume. Silver remains inside its own bull flag pattern, but it has broken below its bullish trend line, which is not a great sign, suggesting that the bullish trend has weakened. Nevertheless, key support holds at 28.70, which was previously resistance, and it kind of marks the point of origin of the breakout. So I'm still expecting silver to trend higher in the not too distant future, but we do need to see a key bullish reversal pattern following this lengthy consolidation here before turning tactically bullish on silver once again. Unlike gold and silver, crude oil prices have rallied sharply in recent trade, and following the V-shaped recovery that we saw a couple of weeks ago, oil prices spent quite a significant amount of time holding in a bullish consolidation pattern above the May's high of 80.63, and that consolidation was important to the bulls who were looking to see higher oil prices, which is now the case because we have broken out of that mini consolidation pattern to the upside, breaking the process the 61.8% Fibonacci retracement level. Oil prices are now rising towards the 78.6% Fibonacci retrace, which comes in at 84.10 or thereabouts. Above that, we don't have anything significant until the April high at 87.29. Can we see oil prices rise to 90 thereafter? Well, that could be the case unless we see demand concerns resurface on the back of this week's key economic data releases. Support, meanwhile, comes in at the top of this consolidation area at around 81.65-ish. Below that, we have that $80 level, which is now the line in the sand, insofar as this bullish trend is concerned. For more market insights, make sure to check out the news and analysis section at cityindex.com. I'll see you in the next video. Take care.